Welcome. First of all, welcome to the Pitchslam. This is hosted by Verivest and Fairway America, our two companies. This is the second year we've done this. Did it last year and had a really good reception. People seemed to be pretty fired up about it, so they asked us to do it again, and here we are. Let me walk you through how this is going to work. So we had about 90 plus applicants come through to apply to present. Kellen Stevens on our team did a tremendous amount of work doing all the screening of the applicants. Please say thank you to Kellen. He's here today. Thank you, Kellen. We narrowed it down to 12 presenters. 12 presenters are going to come up here the next 2 days. We were going to do 6 and 6. We had a last-minute plane flight snafu, so we're going to do 5 today and 7 tomorrow. And then we're going to pick the judges. Then are going to convene after tomorrow's presentation, and we'll pick 4 finalists. On Friday morning, the 4 finalists will come back, give a 2 or 3 minute summary, and then get grilled by the judges for another 5 or 6 minutes, asking questions. So the people are going to have, we'll have 2 winners in the end. We'll have a first place and a second place out of the 4 finalists, and the winner will get a $400,000 investment from the panel of judges. The second place winner will get a $200,000 investment from the panel of judges. And very key point, those investments are subject to due diligence after this event because none of these judges want to make an investment without doing any due diligence. Last year, I would say our winners was Mag Capital and TechVestor, our inaugural winner and second place. They did end up passing due diligence, and they did receive their $400,000 and $200,000 investment respectively. So we fully expect that to happen again, but you never know in due diligence, right? That's why you do it. We have 5 judges, yours truly. Let me introduce the rest. Ash Patel. Lisa Moore was kind enough to join us as a last-minute replacement for Veena Jetty, who was here last year. So thank you, Lisa, and thanks, Veena, for filling in your spot. Dan Hanford and Joe Fairless, both of whom were here with us last year. So that's your 5 esteemed judges today. Okay, so are you ready? All right, well, let's get going. Without further ado,
hey, Matt,
yes.
Can someone in production close that door back there? It's tough to hear. I want the presenter to be able to hear.
Okay, so we'll give a quick second here and close that door in the back. Thank you.
Thank you.
All right, so stepping up, it was our first presenter that was not able to be here today due to a plane flight cancellation. So our second presenter is now our first presenter. So he's very happy about that. So please help me welcome Zach Alms from 507 Capital.
All right. Who wants to hear about strip malls and retail real estate? I am Zach Alms, founder and managing partner of 507 Capital, a private equity commercial real estate company focused on acquiring triple net lease retail strip centers across the Midwest. And now I got to figure out what's the clicker here.
There you go.
Is this it?
Yep. Just press the green button.
Oh, okay. So I'm going to jump into the fund right now. We are currently raising for our triple net retail fund. It's a $10 million fund. We're going to go out and acquire 6 to 10 strip malls across the Midwest. This will be open to accredited investors only. We'll have 2 share classes, a Class A share, Class A1 share at $100,000 minimum, a 6 pref, and then a Class A2 share with a 7.5 pref at a $500,000 minimum. I'll come back to the rest of this later. All right, so because of the nature of a triple net lease, we have very predictable income over the course of the long-term leases, which creates a great risk-averse, consistent cash-flowing investment from day one. Retail real estate is at its lowest vacancy rates on record, so it is currently performing very well and is an exceptional, amazing asset class to be in. Current acquisition cost versus build cost makes buying pre-existing strip malls very appealing. Because of the high cost to build and the low vacancy rates, there is unmatched demand, which creates upward pressure for rent rates to grow exponentially over the next few years. Retail has proven to be very resilient as well, as it has been less affected by the fluctuations in the cap rates and interest rates through the pandemic and the inflationary period that followed. Multi-tenant retail specifically never had those drastic cap rate compressions like multifamily or other asset classes may have had. The buildings we focus on are occupied by high credit tenants that have nationally recognized brands that are internet and inflation resilient. Think of Starbucks, Aspen Dental, Chipotle, Qdoba. With a triple net lease, we are able to also bill back property taxes, property insurance, and common area maintenance costs. So as these costs fluctuate up and down through with inflation or whatever it may be, we can always pass those off back onto the tenants. We currently focus on strip malls in well-located retail corridors with high traffic counts in secondary markets with good upward growth throughout the Midwest. 507 focuses on these strip malls because of the small tenant spaces. They have, the small spaces tend to have a higher demand and a larger tenant pool. They are easier and cheaper to backfill should any vacancies occur. And the tenants have a higher focus on the service versus the product, such as a dentist, chiropractor, hair salon, nail salon, massage studio, phone repair store, quick service restaurant, the list goes on and on and on. We also found a sweet spot in only acquiring buildings under 50,000 square feet. This way we are not dealing with the big box or junior box retailers, which helps lower the risk of having the majority of the building go vacant should any of those box stores leave. We have done multiple retail deals, one of which has gone full cycle and another that we just completed a cash out refinance on. Our most recent deal is also performing very well and is on track to exceed projections. We're currently paying over the pref amount and there's a ton of upside potential left to grow NOI substantially over the next few years. Let's see. As founder and managing partner of 507 Capital, I have over 14 years of active real estate investing experience. I started this company 2 years ago so that others could join in on my investment journey and to give back to the communities we are investing in. My team is compiled of a group of rock stars with over 40 years of retail real estate experience. They've transacted over $1.5 billion in assets and are all world-class experts within their fields. So some of within the fund we'll have stabilized and value-add deals. So most of the deals will be stabilized, but we'll have we do value-add deals as well. Here's a value-add we did. We took it with a little bit of paint and landscaping and new signage. We took it from 60% occupancy all the way up to 97% occupancy. And we just did a cash-out refinance on this deal, and we 2x'd the investment just on the refinance with equity and still in the project. So the triple net fund, it's again a $10 million fund. We are, it's open to accredited investors only. It was going to be a 6 pref at $100,000 minimum, and then the A2 share will have a 7.5 pref. Following the pref, there'll be a 70-30 split, and then a 50-50 split upon a 2x multiple. Our fees are pretty low. We'll have a 1.5% acquisition and disposition fee, and then just a 2% asset management fee, which is not off of AUM, it'll be off of gross rent. This will be a 3 to 7 year hold period. Projected IRR will be 12 to 18% because most of the projects will be stabilized. Most of the properties will be stabilized. It's a good long-term, stable, consistent cash flow play. And then equity multiple projected at 1.75 to 2.25. We do have 2 properties already identified for this fund, one being a Starbucks anchored strip center and another being a Walmart out parcel. And they both have long-term leases, and they will be very stable long-term tenants, and they'll be cash flowing from day one. I think that's my time.
Okay, thank you. So we have 3 minutes for questions. Judges, do we have any questions?
Perfect.
I'll ask, in this market, what are the biggest risks that you see with this deal for your 2 potentials that you have so far?
Yeah, for those 2 deals, the biggest risk would be the tenants leaving, but we have 5 and 10 year leases in place. Because there's such long leases in place, and the triple net lease, so we're able to bill back all those costs that fluctuate. There's not a lot of risk. It's a pretty stable, risk-adverse investment.
Osh, did you have something?
Yeah, Zach, great job. I'm a retail investor. The two deals that went full cycle, can you dive into some of the returns on those?
Yep. I wish I could click backwards, but we had a Starbucks anchored center that we sold in under 2 years. It had a 50% IRR and a 2.5x multiple in that under 2 year time frame. And then the cash out refinance we just completed, we 2x'd the initial investment on just the refi, and there's still equity left in the property for when we decide to sell, and it's cash flowing, I think, 10% right now as well.
Do you have any operating reserves in place for this fund for TI allowance for future tenants?
Yes, we'll be definitely raising for TI and CapEx and stuff like that in reserves.
What kind of occupancy do you buy on these properties?
So most of the projects will be stabilized, but the value add deals will be anywhere from 60% occupancy and up.
How do you determine when you're going to buy a value add deal versus a stabilized deal in a fund like this?
That's a good question. Kind of as they come to us, the idea is the stable long-term consistency of the investment, of the fund, but we also want to juice some returns. So as we see good value add deals, we'll try and take them down. We actually just got a accepted LOI on one in Michigan. It's an outlot to the #1 trafficked Walmart in Michigan, and it's currently 83% occupied, and it's got an end cap available to be leased, which would be a perfect fit for like a quick service restaurant. And that's a pretty low price point investment. It's only at $2 million, but I think we'll be able to get it up worth $3 million pretty quick and easy.
At the risk of sounding like a podcast host, what's the worst retail deal that you've ever done?
Worst retail deal I've ever done. In 2021, we bought and this was just me and one JV, we bought a deal at a sub-7 cap with not a lot of upside, but it still cash flowed nearly not 10%, and I still kind of regret that deal because I think we could have done better, could have bought a better investment at the time.
Is the fund live right now? Have you raised any money? Or?
Yep, we're about, of the 10 million that we're raising, we launched it a week ago, already got about $1 million committed.
Great, thank you, Zach.
That's hilarious.
Appreciate it.
Nice job.
Okay, our second presenter, please help me welcome Tari Thomas from There's Room.
Sorry.
So you may be asking why there's room. There's room because 1 in 4 renters spend over 50% of their income on rent, leading to eviction, homelessness, or barely affording their basic needs. However, there's room because the average minimum wage worker will need to work double their wages just to afford a modest 2-bedroom apartment. There's room because after the death of my sister's spouse, she needed to know that there was room for her to get back on her feet and be able to work part-time while she finished her nursing degree to provide a better life for her family. Fortunately for her, she had me, but for those that don't, there's room. Hi, my name is Tari Thomas, founder of There's Room, a co-living platform where we provide affordable rooms for those who need it near where they eat, work, and sleep. We have been on a mission since my sister's journey, since 2019, to answer the affordable housing challenge for those that fall in the gap. These are people who work too much income to be able to afford any sort of government assistance, but don't make enough to afford a 1-bedroom apartment. These are those like Kathy, a 60-year-old woman in the middle, who, as a single mom, worked 30 years as a medical transcriptionist, only to find after COVID her rent would increase $300 and she would be on the brink of near homelessness. And that is the reality that we're facing across America, with a shortage of over 7.3 million affordable homes across the nation. A lot of renters are searching hopelessly to find a space that they can afford. In the state where I actually live and operate, Arizona, the 4th worst state for affordable housing, there's over 163,000 shortage just in the city of Phoenix alone. And that's where There's Room steps in. Even though there are not enough affordable units, there are enough affordable rooms. And there are government officials working to find creative solutions like co-living. So, what is co-living? Co-living is where two or more unrelated people live in a home, share the common area, the expenses, but have their own private bedroom as a safe haven. This is something that we've been operating since 2019, serving over 200 residents to be able to find a place to be able to grab more of their financial future. And we also know that this is a growing trend just as government officials try to ease the burden of affordable housing. So how does it work? How do renters find that affordable space? Well, they go on our website, they search for the affordable places where they need it, they match with like-minded individuals who they want to be a part of that housing community. We screen them to make sure that they meet our rental qualifications, and then we provide a lease for peace, which are flexible leases that have housing contracts to ensure there's peace and harmony in the home, and to ensure that there's one payment that includes all rent and utilities. But this just doesn't benefit our renters. It also benefits our owners. Because we rent by the room, owners are able to get above market rents over a traditional single-family home lease. It's a win-win solution that many people aren't talking about. So, as a result, we're able to do even more social good because we are providing our renters a $300 savings over and above a one-bedroom apartment. So, let's talk about There's Room's track record. We have been operating over the past 4 years, and we've been operating the There's Room model in 20-plus properties across the valley in Phoenix, and we've been able to gross over $40K in rents. Due to our streamlined operations, we've averaged a vacancy rate of about 6% across our properties with an average tenancy of 9 months. People want to stay because we create community. In addition, we've been able to prove the viability of our model with an average 19% cash-on-cash return to our investors. We've been really able to prove by just the partnerships that we have across the local community on what it means to partner to do social good. So what's our business plan? Our business plan is to instead of master leasing properties, to now purchase 10 single-family homes, and we will purchase it under a co-living private fund. We will convert your traditional single-family house, 5-bedroom house, into a 6-person co-living facility. That's going to average about an $886 per tenant in the home. So that extra room will come out of an converted office, and that leads us to generate 36% above your market rents for a traditional single-family home. So for our investors, we are able to offer a 7% cash-on-cash return. We're purchasing at a 65% loan-to-value with a 5-year hold, which we will either sell or refinance, and we're able to return about 1.x over a 5-year period with just under a 17 average annual rate of return. So, in closing, if you invest in us, you provide the opportunity to really expand this social impact. For Kathy, she was able to find that affordable space she needed 3 days before being in a homelessness situation. But for you, as savvy investors in the room, looking for greater returns and to do social good, there's room.
Thank you, Tari. Judges, we have some questions.
Thank you for sharing, and what a model, what an innovative model. Is it not to put it in a not to like get to a core of a message? I'm just trying to picture like how this model is compared to other stuff that's out there.
Yep.
Is it kind of like Craigslist with screening for low-income individuals?
No. Well, Craigslist is, it's a random hodgepodge of different things. So most people would compare it to like a pad split. So you're taking a house.
A what?
A pad split, but you may not know what that is, right? But you're taking a house, each room, everybody has their private lock and key. They're sharing all of the utilities and sharing the expenses. We bake that into the lease. So we've already taken an average over the year of what those expenses should be. We bake it into the rent and the lease. Each individual has a private lease, so they're not dependent on any one individual. And then we have a housing contract, which talks about just the things to make sure that everyone comes in on the same ground floor with what the ground rules are within that home. And then they have 3 strikes. So just so you know, like if you're violating a rule, it's a violation to the lease.
With security deposits?
Yes, security deposits, yes, absolutely. And these are low to moderate income individuals. We've had nurses in the home. We've had, your daycare workers. I mean, you'd be surprised the people who fall into this space.
Is there more, where's the bottleneck for you in the business? Is there, as far as supply of individuals who need it, or just getting more homes?
Yeah, getting more homes was the challenge that we had more, because more people weren't aware of what it was, the concept of it. After COVID, it really kicked it up, because you found a lot of city and government officials really looking for creative solutions, and they were willing to fund whatever, right? So even though a high percentage is not government-funded individuals, a lot are just your retail renters who's just like, yeah, I'm in a space. We have also a lot of seniors that are also wanting to enter into that space because they can no longer afford a lot of the rentals that they have. So it's, I'd say, anywhere from $15 to $20 something dollars, people who make that from an hourly wage standpoint, that this is a perfect space for them. And you'll find those outliers who make more, but they just say, hey, we wanna save.
That was going to be my next question, or the question I had is around, if this is designed specifically for that gap in the market,
It is a gap.
how do you limit it to just those people in that gap instead of allowing people who make more just to do it to save money?
Well, I mean, you can't. I mean, if they want to do it, they could do it, right?
Mm-hmm.
So I think it's really what they feel comfortable with. So I've had an engineer that's actually rented a space, and they just wanted to save money. So we won't turn that away, because, I mean, if they can afford to do it and they want to do it, then we still allow them the opportunity. But we also work with local. That's it.
Thank you.
Sorry, thank you.
Great job.
That's a new innovation, by the way, from last year that they incorporated that saves me from being the bad guy to have to cut people off. So sorry about that, Tari. I did not plan that. Okay, next presenter. Please help me welcome to the stage. We have 2 people coming up to present, Matt Faircloth and Hervé Francois from DeRosa Group.
Thank you. Thank you, everybody. Good afternoon. My name is Matt Faircloth. When my wife Liz and I founded the DeRosa Group almost 20 years ago, we wanted to create a business that could make a lot that impacts in the lives of many people, make a difference. And we chose real estate investing as the business vehicle because this industry has a unique ability to make an impact on so many people, right? That was the birth of the mission of our company, to transform lives through real estate. Through the years, the DeRosa Group's been committed to turning neglected properties into thriving communities for our residents while providing a fulfilling career for those that help us instill that vision, and producing competitive returns for those that know that their money is making an impact while it's making them a great return. We've carried this vision forward through dozens of multifamily deals, but wanted to create something evergreen, something that can grow organically and build momentum over time. Which brings us to the newly launched initiative, the DeRosa Income Fund. Our mission-based short-term fund, AKA hard money with a heart. With the DeRosa Income Fund, we work with borrowers who have projects that are in line with the company's mission to provide housing, jobs, and safe collateralized returns too. Although DeRosa is excited about this short-term loan business, we don't want to take the risk of building a whole new division of our company from scratch. We needed a strategic partner to help service those loans, our ace in the hole, so to speak. From our network, we found a short-term loan company that until recently was funded by a family office. They had grown from $5 million in loan productions to $250 in loan originations per year, and they even had in-house legal. What's impressive is that in the 7 years of this company's operation, they had no defaults, not one. The problem was this family office that had funded them up until recently was dissolved. They were left without a funding partner, and that's where we stepped in. They were aligned with our mission, and they could easily produce the loans to fill the fund's needs for the foreseeable future. And with that, let me share with you some impressive figures that the DeRosa Income Fund has generated so far. Since its inception, the DeRosa Income Fund has created 65 jobs. 16 vacant buildings have since been revived, 20 housing units have been put online, and there are currently 9 new construction and new development projects underway right now. And we even helped open up a beer brewery. How cool is that? And we're just getting started. We've had such a great time with this too, funding some really cool projects, and because America runs on Dunkin', except for in this town, by the way, because this cup right here had to travel from New Jersey because there's no Dunkin' Donuts in Salt Lake City, we found out. There's a Dunkin' Donuts in our portfolio as well, right? So I'm going to leave this slide right here while I welcome to the stage DeRosa Group's acquisition manager and one of my business partners, Hervé Francois.
Oh, I wonder if that means that they're going to give us some free coffee. I do love me some Dunkin'. Thanks very much for that warm welcome, Matt. What's great about investing in the DeRosa Income Fund is that you don't have to wait for the right deal to come along in order to make an investment. The DeRosa Income Fund is an open-ended fund that allows for investors to get in at any time and start receiving a steady stream of revenue right away. By now I know what you're thinking, this transforming lives stuff is great, right? But what's the hard numbers behind this fund? As previously mentioned, we launched this in July 2023 as a 506c offering for accredited investors only. We currently have $5 million under management, $4.7 million here when it went to print, with a cap to get to just $20 million. The minimum investment is $50,000. With that investment, you'll see an annual preferred return of 8%. And on top of that, investors receive a profit share that further enhances the returns they receive. Currently, our investors are making over a 10% annualized return. With the DeRosa Income Fund, an investor can receive either a direct deposit into their account or they can compound their distribution back into the fund. So think about this. You now have the ability to take distributions from their syndicated deals and invest them into the DeRosa Income Fund, and then from there, elect the compounding. That's making more money on top of more money, and that's powerful. Also, you're investing as a partner, not as a lender. So rather than getting a 1099, you'll be receiving a K1. We are conservative on selecting which deals we lend on, as borrowers must provide a personal guarantee, and we only take a first lien position. This approach has resulted in an average loan to value of 46%, and most of the deals we invest in are less than 10% of the overall fund, with the average loan size of $445,000. And guess what? We charge no fees, as we only get paid a profit share of the waterfall over 8%. Now that was a lot, but nonetheless impressive, right? But wait, there's more. As a result of our conservative process, we have received 0 defaults on payments, and not even one borrower has paid us late, not once. We also fund businesses from all over the country with owners of all backgrounds, because we believe that a good business concept is a good business concept. And that's as good as it gets. All this to say that when you trust us with your investment, you can do so knowing that you'll feel good about what you're investing in and what you're getting out of it. Matt, I'll turn it back over to you.
We know that to some, investing in a fund like ours might seem like would only make a minor impact. But together, for those that we are helping, it can really make a world of difference. We sincerely hope that your investment goals align with ours and you're able to join us in transforming lives through real estate by investing in the DeRosa Income Fund.
Okay, well timed. Okay, judges, we have 3 minutes for questions. Maybe I'm going to ask you, start here, is what type of borrowers and properties specifically? Can you give us like some examples?
So we're agnostic to property type. We have mixed-use buildings. We have a warehouse redevelopment project underway. We have several new construction projects. So we are asset class agnostic. It just has to fit the company mission, and we also have to be able to get collateral and that.
Commercial, non-owner occupied.
Of course,
right?
yes.
Yeah. Okay.
What markets are you basing your investments on?
We are currently, help me here, in Pennsylvania.
So we're currently in Pennsylvania, New Jersey, New York, and Delaware, but we would invest in all 50 across states.
question for you. We have a debt fund ourselves, and it's a totally different fund, but I'm curious, how do I get my money out?
The fund's liquid after 1 year,
Okay, so after 1 year, how long does it take to get the money out?
90 days or less.
90 days. So after a year, at any point in time in the future, I can ask for the money out, and I get it out?
Yes.
Okay, all right. And what's I think you had mentioned that most of the loans are less than 10% of the overall fund size.
Yes.
That's correct, yeah.
What's the largest loan you have in the portfolio?
1.3.
1.3 million. That was the very first loan that we had put in deal. That's when we had launched the fund last July. We need to go ahead and put money to work. Right now, again, the average loan size, $445,000, even a little bit less, since we put that first million to work right away.
Smallest loan's 118,000.
What's a typical term of an individual loan, like rate, fees, duration?
So it's on the loans go out around 12 plus 2. We have some at 12 plus 3. We have some at 15 plus 3. I should note that our origination partner is keeping those points. That's their compensation. We get the interest rate splits. But yeah, the term is somewhere between 6 and 9 months, depending on the deal. And we don't do extensions.
If you originate a loan, what's your fee structure and how do you guys get paid?
So it's 8 pref, so 8% all goes to investors up to 8, and then we do a 50-50 split above 8. So our comp is 100% win-win. If the fund makes more than 8, we get half of that.
So we don't charge any incoming fees to investors to participate in the fund.
Judges.
What is it making day one if we invest? What is it making annually? 8%?
The eight's the pref, but the average now is
9.49% we're at right
yeah.
now.
We did 991 last month, so but 9.49 is the average.
That's the average since July of 2023?
Yeah.
And a little over 9%
Yeah,
Yes.
correct.
annualized return?
Mm-hmm.
The Dunkin' Donuts, are you investing in the business, the real estate, or both?
The real estate. So it's the development of a Dunkin' Donuts. So, and the way we looked at that, that's going to create jobs. The Dunkin' Donuts had jobs. The beer brewery had jobs. A lot of new construction.
Great job.
Okay. Thanks, guys. Thank you. All right. We're getting used to that ending now. Okay, our fourth presenter, gentleman I've known for a number of years and had the pleasure of doing business with, Mike Zlotnick from Tempo Funding.
Hi, everyone. Thank you all kindly. Appreciate your time and attention. Wonderful disclaimer. We'll go straight forward. I'm known as the Big Mike Zlotnick, and I come from, like James Bond, instead of from Russia with love, from Moldova with love. Moldova is the republic of the former Soviet Union. I immigrated in '89. I'm a mathematician by education. I'm a chess master, and I love what I do. I used to be a technology professional for 15 years, and then I went real estate full-time in 2009. That's where Tempo Family Funds started. A wonderful team. 3 folks are here of the team. Please stop by our booth. We've done quite a bit of business. We've worked closely for many years with Matt, Fairway, and Verivest. We've done over 1,000 loans, hard money loans, and other commercial loans. We've raised and invested over $150 million in commercial real estate deals. And we're going to jump to our flagship income fund, Tempo Income Fund. So the fund utilizes dual strategy. The fund has diversified strategy, Class A, B, and C units, as well as a focused strategy, Class D units. We'll talk about that in a second. In the diversified strategy, we do hard money loans. Effectively, we mix lending with equity investments that are focused on income. On the equity front, we do multiple deals that are income focused, some open air shopping, some industrial. The fund doesn't have any multifamily, but it intends to invest in income-focused multifamily. So that's a diversified strategy. We also do some mezz debt. And then on the class D1 through D4, we work with a group called discountlots.com. These folks buy lots for cash, recreational land, for uses such as running dirt bikes, shooting guns, erecting camping grounds, as well as other recreational uses, and then they sell them on seller financing as they create receivables. We'll talk about that in just a second. Again, Class A, B, and C units, intention is to do income-focused multifamily, industrial, self-storage, open-air shopping, and conservatively leverage debt investments. On the discount lots, these folks buy land lots, as I mentioned, recreational, not city, all over the United States, mostly focus on South, and they sell them to folks who want to own the American dream piece of dirt. And it works incredibly well. We work with them for quite a while. We monitor them on a monthly basis. It's a phenomenal strategy, has worked through market cycles, and that's what the Class D units are all about. Just as an example, they'll go buy a land lot for $3,000 cash, and they'll sell it as receivable for $18,000, $250 down, $250 a month. And the fund loans the money to discount lots between 16 and 18%. We actually started loaning to them at 18%, but they've been performing flawlessly, and they asked us for a reduction in the rate, and we did. We cut it to 16% on the new draws. And then we pay investors, you're going to see through the fund structure, we pay investors 12 to 15% through the Class D units. And they're secured by the pledge and assignment of the entity that owns all the lots, all their cash, receivables, and inventory. Class A, B, and C unit target return is 8 to 12% per year. You're going to see performance far above that. Obviously, best results don't guarantee future performance. And then the Class D units pay fixed amount between 12 to 15% depending on the invested amount. This is an open-ended fund. Quarterly subscriptions, quarterly redemptions, 2-year lock-in. Welcome to IRA investors. Works really well when they invest in debt units. For example, Class D1 through D4. And that generates no UBIT. Recent results, here's a snapshot. I believe this is as of the end of Q3. Q4 just came out. Because of the slow process Q4 closing, we got to receive all the K1s. We just closed Q4, and the Q4 numbers are very, very similar to Q3. They're between 11.3 to 12.7 on the Class A, B, and C units. And then historic returns since inception are even above that. The Class D units are very simple. Depending on the capital investors, folks get 12, 13, 14, or 15% per year, and that money is deployed between 16 and 18%. We're conservatively focused. We invest in hard money loans that are conservative, obviously income focused, that typically are leveraged with fixed rate debt. Conservatively minded sponsors and strategies. The fund distribution quarterly basis. Reinvestments are allowed on quarterly basis. We provide quarterly webinars, quarterly reports. We use VeriVest as a fund administrator. All the statements, tax statements, quarterly statements get distributed through VeriVest platform. We use Armanino as an auditor for this fund. If you'd like to learn more, please scan the wonderful code. And, final. So as I was talking about the podcast, I have 41 seconds, 35 seconds. So I do run a podcast called Big Mike Fund Podcast. And if you're bored, you got nothing else to listen to, please go to the bigmikefund.com. And if you misspell it, you forget the D at the end. I promise it's not a kinky site. I'm done.
Thank you, Mike. All right. Judges, we have 3 minutes for questions. I have one, Mike. Is the Class D, is that like a wholly separate thing?
No, it's a single class within the fund, and the Class D units, the capital we raised there, we loan it to the discount lots. We have $10 million advance on the line. Through discount lots, it's raised through the Class D1 through D4 units.
But the Class Ds have no exposure to the other assets?
Correct.
And the Class A, Bs, and Cs have no exposure to the
we actually allowed to have a small exposure from A, B, and C into D. So from A, B, and C, we can diversify into D, but not the other way around.
Okay. So it's basically like a separate vehicle.
Yeah, it's like a separate vehicle within the fund, exactly.
Okay.
After the 2-year lockup period, how long does it take to get the money out?
So we've had very few redemptions. The fund launched in August 21. At this point, we've been able to redeem folks on a short notice. We've not had an issue of delayed redemptions.
And how would you define short-term notice?
So typically, we don't want to be told, redeem me. So after 2-year lock-in period, we generally like to communicate with folks with a 30-day notice. As you know, even hard money loans, you don't push a button, redeem overnight. So we want to have some liquidity planning. So I'm very open, transparent with folks. If you want a redemption, request it as early as you can. We're happy to plan for it.
And how much is in each one of the separate classes?
So total fund has 17.9 million. 10 million is in Class D. Those are the discount lots money, and the rest is hard money, open air shopping, etc.
Okay.
Do you have a target level of diversification amongst, you said, because diversified strategy, in terms of like multi and retail and industrial and so forth, or is it varies depending on deal flow?
It depends on the deal flow, but the target is not to write any check over $1 million. Historically, we've run our funds up to 25 million, maybe a little over. So if you're running 25 million, you don't want to run checks over $1 million. That has to maintain diversification. So a lot of the checks we write within the Class A, B, and C is $500,000 to $1 million. It's our sweet spot.
And how much of the fund has currently not been deployed?
The fund is fully deployed.
It's fully deployed at this point.
Yeah. We maintain some cash in the bank, but that's small, a couple percentage points.
And it's open-ended, correct?
Correct, open-ended, quarterly subscription and redemption process.
Who's the third-party administrator?
These slackers, they're called Verivest. We've been working for a long time, so Matt can take some abuse.
Class A, the projection was 8 to 12%, but when I saw it, it was 16% annualized return, the most out of any of the classes. Why is that? I know you have 5 seconds.
Yeah, so we started with a lot of discount lots and very few of Class A, B, and C. Arbitrage between the discount lots and the Class A and B and C go to Class A and B and C. We don't collect that other than the fund waterfall.
All right, thank you, Mike. Just leave it there.
Good, thank you. Thank you.
Okay, thanks, Mike. All right, one more. Please help me welcome our final presenter for today, Forrest Jinks from Altus Equity.
I think it's good afternoon now, and I know that I'm the last thing before lunch, so I'm going to try to talk fast. My name is Forrest Jinks. I'm the president of Altus Equity Group. Chad Richards is also here today in the crowd. Please feel free to reach out to either one of us up till Friday to ask any questions about this exciting opportunity if you like it as much as we do. I'm going to skip this slide. You've all seen it, and we're going to go straight into where we see opportunity in the current market. Everyone talks about distress. We know it's there, but we believe it's a lot more nuanced than what is in the press, and so we think that there's particular niches within the distressed areas where we can outperform. The second bucket is problem solving. The broader distress in the finance markets has caused trouble for good projects in good markets with strong back-end demand. Altus has made a name of ourselves by solving problems, and so the bigger universe of problem solving there is, the more opportunity there is for us, and then the fund, and then the investors. And lastly, we've been hearing about debt, and we totally agree. Whether it's new private debt originations or buying existing loans, the opportunity in debt is as strong as it's been in the last 10 or 15 years. By overlapping these strategies, we are confident that we can reduce the risk of any one strategy on its own. So SPEs have been kind of the vehicle du jour over the last many years. We've done some funds several years ago, but we've been doing SPEs. But that was the way the market was in the past. The way the market is now, we can't use SPEs and have the success that we want. We have to move quickly, we have to move with confidence, and sellers and brokers and lenders have to know we're going to close. We have to say no 5 times, 10 times, 100 times, and then when we say yes, we have to close, and everyone has to know we're going to close. So with the buckets of opportunity, knowing we needed a fund, we went to our investors and said, what do you want to see? Their feedback helped us come up with this fund strategy. So there's a portion going to debt, both performing private debt, that pays a yield with our year one target between 4 and 6%. There's a portion going to non-performing loans, much higher returns, but also that's much more lumpy when it comes to the returns. The second bucket within the fund structure is GP investments. You're all familiar with GP LP splits. The GP benefits from the promote, and that return is basically a risk-free return on the invested capital. That all goes into the fund. The last bucket is the distressed investments. Right now we have one project in contract for $12 a foot on an industrial deal. That's so far below replacement cost. As you can imagine, the returns are great. Non-levered 5-year IRR in that deal looks to be just under 40%. Now, you're not going to see this in the fund docs. You're not going to see it in this presentation. You're not going to see it in our pro forma. But if you take the second bucket and overlay it on the third bucket, put the promote on top of the distressed investment baseline, suddenly the fund is earning 40, 50, even 60% returns on those investments. I've been involved in real estate since 1999. July will be 25 years since my first investment. Our team has done most all types of real estate classes. Right now we're focused on for-rent residential, industrial, and to a lesser degree, retail. But I want to bring your attention to the bottom right. While we feel like we're pretty good investors, and I think the numbers bear this out, the most important thing that we track is our investor retention rate, because that tells us how we're doing in our number one goal. Our hedgehog is to be the best in the world at taking care of our investors. That's transparency, communication, proactivity, alignment. And we'll talk more about alignment when we get to the fund structure. This is the team, leadership team across the top, board of directors in the second row. The first 3 board of directors there have been working with Altus for over 10 years. They are not real estate people. We brought them in to help us with our business operations because as a company, we cannot provide our investors the level of product and service that we want unless we have a really solid base that we're working out of. Kathleen joined us a couple years ago. She has more real estate experience, and she is the head of the investment committee for the fund. The rest of the teams there below, and on this page, 75% of the people on this page have bought into our operating company and our holding company out of their own pocket. We hear a lot about returns. We hear less about risk. Altus feels like that's backwards. Risk has to be part of the conversation, and that's risk when you make an investment with a sponsor, with a fund, et cetera, and then risk from the fund into each individual investment. And so this tab just shows you different ways that we try to mitigate risk throughout the process. Speaking of mitigating risk, I skipped this on an earlier slide. Being involved in real estate since 1999, I have been through, this will be my 3rd real estate recession as a sponsor, and I was I was working with real estate before that. I've got a lot of scars and have learned about risk and some things to avoid. Here's the money slide. 12% preferred return, all cash, 100% return of capital, and then a 60-40 split. This is where we show alignment. There's a ton of opportunity in front of us right now. We're putting our money where our mouth is and saying we're paying 12% prefs. If our investors make money, we'll make money, and we want them to make a lot of money. That should result in a 20% 5-year IRR. Lastly, 5% of our promote is going to these 3 causes. And if you look at the QR code here, that will take you to our fund landing page and overview slide deck.
Perfect timing. Perfect timing.
I've only practiced about 500 times.
Forrest, can you elaborate on the 40% IRR industrial deal?
It is a Class C. The company went out of business and was fairly lost. We've been working on buying it for 9 months, and it's just been sitting there empty. So it's going to be a combination of lay-down yard and just storage.
What's the purchase price?
It is $4 million. It's 300,000 square feet, roughly 300,000 square feet. And we have about 500,000 we have to put into it for improvements.
Thank you. Great job.
Which, by the way, is a weird conundrum because we don't want to do projects that small necessarily, but when you have such a great basis, that same project at 300,000 square feet in LA would be, $30, $40 million project.
So you mentioned you don't want to do deals that small. What's the average size deal that you're looking to do?
So going back to the niche on the distress, we have seen and strongly believe that above 50 million, those owners are going to be able to solve their own distress because it's mostly financial distress, not fundamental distress. Below 50 million is where, unfortunately, a lot of people in the crowd and different people put together money and don't have the ability to solve it. So if you get below 10 million, a lot of those owners have personal guarantees and everything else. They're going to do everything they can to solve the distress. So we think it's going to be between 10 and 50 million.
What are your expectations around real-time distributions versus like a J-curve style fund where you don't pay because like the GP stakes and distresses really don't have cash flow, right? So,
well, we're allocating based on the feedback from our investors. We're allocating to performing debt, and so we're trying to hit, and we think we can, a 4 to 6% yield year one, and then as projects come online, that'll ramp up. And there'll be kickers now and then as some of the MPLs pay off. We have, I want to say 34 already in the portfolio, and I think we've resolved 10 of them already, and those checks should be coming, within Q2, Q3.
Who's your third-party administrator?
I just blanked on their name. Chad's out there. You can. High Divide. Thank you.
Say it one more time.
High Divide. They've done a debt fund for us as well. We've worked with them actually 2 different debt funds, so they're great to work with. Jack's his name if you want.
how much do you have in the fund right now?
I don't know the most recent, but I think we're probably pushing 12 million. We have a goal of 100 million. We just launched a couple of months ago. I'm not sure we're going to get to 100, but we're going to try our hardest.
What's the largest deal you guys have done to date?
We are weeks away from finalizing construction on a $1.4 million construction Class A industrial deal. Right now, it's about 150 million.
So your largest is 1. You're aiming for 10 to 50. Who on your team has done deals that size and
10 to 50?
Yeah.
Actually, most of our deals are that size. So if you look at our portfolio, most of them are between 10 and 50. The large industrial deals, a little bit of an outlier. But going back to the problem solving, sometimes things fall in your lap. So.
Okay, thanks, Forrest. Thank you. All right, well, that's it for today. Please come back tomorrow, and we'll have 7 more. And after that, we'll choose the final 4, and they'll be back here on Friday morning. I don't want to stand between you and lunch. Thank you for being here.